Hi, I'm Joe Parcell. I'm with the University of Missouri's College of Ag, Food, and Natural Resources, and I'm happy to be your host today on this version of Take One for Ag. Joining me today is Dr. Pat Westhoff, Howard Cowden Professor of Agricultural and Applied Economics and Director of FAPRI at the University of Missouri. We're here today to talk about Farm Financial Outlook as it relates to the most recently released Farm Briefing Book Outlook by FAPRI made earlier this week. For those interested in more information on that briefing book and the most recent 10-year outlook, they can go to fapri.missouri.edu to download the briefing book, or we invite you to attend the 6th Annual WOMAC Outlook Conference on April 17th at the University of Missouri. Registration can be found again at fapri.missouri.edu. So Pat, I want to turn, happy for you to join us here today, another successful. How many briefing books has this been that you put out?
It's been a lot. I think we've done this for more than 30 years now.
More than 30 years, so a great service to farmers and agribusinesses in the country, and we appreciate the contributions, not just of yourself and your team now at FAPRI, but for those that came before you. So let's talk a little bit about the Farm Financial Outlook. So let's jump right in. What are the numbers looking like for 2019 on this net farm income?
So I guess the good news is we're looking at a bit of an increase in net farm income in 2019, so that's the positive news. The less positive news is we're still looking at a lower level of farm income in 2019 than we saw in 2017 or recent average of many recent years.
Wow. So what are some of the factors contributing to this lower number, relatively lower numbers to historical in 2019?
Sure. Well, as everybody knows by watching the news, we've had some major issues on the trade front. So that's kept prices for soybeans and many other crops lower than they otherwise would be. Throw in the fact that we've had large crops for several years running, that's tended to depress prices as well. We've got a lot of livestock production out there, so meat prices are lower than people would like them to be in the farm sector. That combination in general has resulted in lower farm income levels than we saw, especially during the boom years of 2010 to 2013.
Yeah, well, that kind of leads in because later this week we're going to be talking to Scott Gerald about crops outlook, and Scott Brown about dairy and livestock. So they'll kind of unpeel the onion a little bit more there in terms of what's going on with those commodities. So let's transition. Let's transition beyond 2019 to what that net farm income looks like from 2020 to what 2028. Is that how far that the 10-year goes? So
we're talking about maybe another slight increase in farm income in 2020. But nothing dramatic, just a small increase in crop prices, giving us a little bit further bump up in the net farm income levels. But then after that, once you correct for inflation, we're talking about relatively flat farm income for the duration of our outlook. So roughly $70 billion of today's dollars every year in net farm income. That's well below the peak we saw in 2013 of $120 billion.
Yeah, so maybe I'll put you on the spot here a little bit. So what is this, we've strung together 4 or 5 good years up until now without really many big hiccups across the entire growing region for crops anyway. Of course, we had some drought issues here in Missouri last year. It had a big impact on us. We know the probabilities of something happening are probably higher every time we stretch this out a year. How do the FAPRI models account for that, or do they account for that?
Right, so we try to assume normal weather is kind of our starting point. So if we do just one outlook for the future, we'll assume kind of average weather conditions. But we know the weather will never be average. So we try to take into account all the things that can make, or many things that can make markets uncertain, including the weather. So we'll solve our models 500 times for different combinations of weather and the like that might happen. Wow. Under some of those outcomes, we get much higher levels of prices and income, and other outcomes we don't.
Yeah, well, that's neat because in the more granulated review of the baseline, some of the presentations you go, you talk about those confidence intervals, and that's really a powerful information that we know.
And if you think about the impacts on the farm in terms of finances, it's not the average year that tends to cause a problem for a producer; it's the bad year. Yep. So having some idea what those bad years might look like and how frequently they might occur is very important.
Yeah, and again, we know that here in the Midwest with the recent floods and stuff for some of those producers, obviously we know it's close to home, but it is isolated relative to the overall growing region, so that's important information. So let's take this net farm income and let's move it onto the balance sheet. Let's talk a little bit about what that debt to asset ratio is projected to be. That's important, of course, to those servicing the ag industry, those lenders and stuff. What does that debt to asset ratio look like in 2019 and beyond?
So I tell everybody whenever I speak to larger groups that this is not the 1980s, but we have much lower levels of debt out there than we had during the crisis years in the 1980s. But the bad news has been creeping up. In fact, increasing at more than just creeping in recent years. We're looking at a debt to asset ratio that was as low as 11.2% in 2012, increasing up to more than 13% in 2018, and getting as close to 15% by the end of our outlook period. That's not an outrageously high level of debt by itself, but many of that debt is very concentrated. So the folks who have the debt are going to be more likely to have issues in front of them. With higher interest rates as well, that's a bad combination for a lot of producers.
Yeah, that's, you think about that, that's at least somewhere between a 25 and 50% jump there. And like you said, if it's concentrated, that's going to have a big impact on there. And, I think, I'm going to guess these things will unfold regionally. Are you seeing anything in the different crop segments in terms of that debt load?
It is different across the sectors. Dairy has been an area of a lot of concern, especially this past year. I know any place that has a crop problem in a given year is going to have a problem. So here in Missouri, for example, we're going to have some issues with folks who had back crops this past year, maybe didn't get fully compensated from crop insurance and the like. They're going to face some challenges. Asset values are an important part of the story, of course, as well. Asset values increased dramatically in much of the country between 2009 and 2018, about a 50% increase. The average value of farm real estate during that period of time. That hasn't been equally spread either. And how that unfolds in front of us is a big deal. And our projection is that those asset values are relatively flat over the next decade. And with debt continuing to increase, that's the bad combination.
Yeah, well, I know those of us in agriculture watch those land values pretty close going out, so we appreciate your thoughts on that, Pat. So, Pat, I want to thank you for joining us on this segment of Take One for Ag, and to the viewers out there, I want to thank you for joining us. The next two segments, we'll talk again to Scott Gerald about the crops outlook, and then Scott Brown about the dairy and livestock. And we want to conclude by thanking our partners from the University of Missouri that we share the support for FAPRI with the United States Department of Agriculture and specifically the Office of Chief Economist. So thank you and look forward to seeing you again soon.